and I've got
Hello,
interns.
everyone. Welcome to episode 26 of the new Barbarians Podcast. Today's Tuesday, July 1st, 2025. The podcast will hit the platforms later today. Today we are joined by Christina Qi, the CEO of Databento. Hi, Christina.
Hey, it's good to be here.
Hello, Christina.
Hello.
And so I'm just going to quickly recap a little bit of last week, and then Mark will take us through the scorecard, and then we'll get into our discussion with Christina.
Yeah,
so
and Bill,
last week we had
also lay on the factors. I know I've read a little bit your preamble. I'd love you to go into that because I'm going to bring that up as well. But I want to hear it from your stats, which are a little bit different approach than what I do.
Okay. So last week we had good inflation news, and Trump is still pressuring the Fed to cut interest rates, and investors are still pricing in a 96% chance that rates will remain unchanged at I guess this week's policy meeting. Interest rate futures are pricing in a 2/4 point cuts by the end of 2025. And then on Thursday last week, tensions between Israel and Iran have continued to escalate. Oil prices surged 12%. And, the regular market outcome associated with that. Tariffs on China now stand at a total of 55%, while tariffs on the U.S. are at 10%. But it looks like that's hopefully going to normalize sometime soon. And then in the factor space, it's back to risk on. Sales growth was up almost 3 sigma last week. EPS growth. So, growth is the story basically in the sigma space, and the, statistically significant factors, sales growth, EPS growth, and then volatility, of course, also rallied 2.5 standard deviations. And then in quality, return on equity sold off about 2.5 standard deviations. And so, it's just risk on, baby. And, sensitivity to oil and inflation rallied. Value actually did pretty well too, but I think that may mostly be a reflection of financials. So to be determined. I might do a quick canvas of the value space, but basically it's back to growth and risk on.
Thanks, Bill. Bill, on return on equity. Return on equity, you said, was one of the losers on the month or recently, right?
Yeah.
What names would load? I would think levered names would load high to return on equity if they're, or is that incorrect way of thinking about it?
So I think that this is a quality sell-off, which is really just rotation rather than sell-off. But as far as I think they could be leveraged names to the extent that that boosts their ROE. But I think for the most part it's a quality play.
Got it. Yep. So instead of taking the idea that any given company has the same earnings, more leverage is a higher ROE, you're saying that factor strip probably in the past year or two loaded high to quality companies that were able to generate a high ROE, probably technology based or just firms that are better at margins, tech, et cetera, or is that too simplistic as well? All right. I think Bill froze for a second. We are going to continue. That is a perplexing question on quality. This is, Christina, this is an absolute turn of events because as I told you, I've been traveling. I just got back from Budapest, and which I didn't know was Buda and Pest, that the Danube split in half. And it was great going to Europe because I got to see a lot of fracturing historical um, appraisals of the fracturing of countries and governments, which we're going to talk about here, which you're doing on the data side, splitting up old regimes themselves coming up from the bottom.
It's a great
And my
analogy.
point is, I had horrible Wi-Fi when I was traveling, so I popped
Oh.
off, and Bill had to pick up. So I feel like I'm earning my keep here. So let's now for that, we're going to share a screen here. What I'd like to do is go into some of the markets. This is unbelievable. This happened just literally. Hopefully, that's the screen that I'm getting. Do you see the central bankers shooting the breeze?
I actually don't see your screen, but I
Oh,
don't.
that's because it didn't come up yet. All right. There we go. So, and did not come up yet again. All right.
That's so strange. It's like popping up and then like disappearing
Yep.
immediately.
You were just mentioning this
Yep. I was
about
just
how
talking
in this
about.
age, right?
I was just talking about this right before we started this recording this live. How it's 2025 and how like this kind of podcasting go live software is absolutely horrendous in this day and age. I don't know if any of
Yep.
you guys have ever tried to do a podcast or anything like that, but it is absolutely terrible. Or manage like a virtual event, by the way, like this, basically.
Yeah.
This
And
kind of software behind the scenes is absolute, as you can tell,
yeah.
absolutely awful. I
So
can
we're
complain
gonna
all day.
we're gonna roll through with it. Fool me once. So what you guys are not looking at here is I took a screenshot in preparing for this, Christina. Bloomberg, which I still think is a great has a great platform. It's very powerful. It gets eyeballs. There's a lot of disruption. I'm on Substack. Bill's on Substack. A lot of people have left mainstream media, so there's a lot of other platforms. But holy moly, does Bloomberg just get it? And I want people. We'll put it in the notes, and I'll put it on our LinkedIn too. Francine Lacroix had Jerome Powell, Francine Lagarde, is it Andrew Bailey from the BOE, and Ueda from the Bank of Japan, and then the head governor of Bank of Korea. And it was basically an anti-Trump. Everyone's like, Jerome, we got your back, no problem. And I think that the Fed has been messaging, and this is about data. The Fed has been messaging for years. It started with a briefcase with Bernanke. Boy, oh boy, I can't even. I forget the guy who dated Ayn Rand back in the day. So the Fed's been messaging more and more because they're losing control over the money supply, because there's more money and they have to be more profligate. So on stage, you had everyone say, basically, we're going to do a new thing called stress testing, Christina.
Mm-hmm.
So when you talk about what you're doing for a living and providing different types and more data to people in a manner in which they get, well, maybe you want to give Jerome a call, because they say they do it, but they don't message with it. I mean, it's fascinating. The ECB said, oh, we've been using it for years, and we message with it. And here's where I think the knowledge is dropped on the takeaway. She said, it helped us with COVID, a once in 100 year. It helped us with the invasion of Ukraine war, and we're doing it now. So she feels an assault from, I think, Trump's attaining lower oil, lower rates, not a lot, but a little bit, and then lower dollar. So they're really unhappy about the strength in their currency, even though their equity markets are higher, because of how much fiscal dominance is hitting them. It's crazy. I really suggest people look at it. So you can't see the slides, guys, but it is clearly first half of 25 was about Trump policy. You have the dollar at a multi-decade 6-month low, 10.5% decline. I mean, this is Plaza Accord type stuff. But in this time, Christina, you didn't have all the central bankers in the same room, all the economic ministers. It was unilateral. It's so bananas. And then oil down 9%, obviously through a very volatile path. And then US equities up 5%, bonds up a little bit. But what made money was euro up 14, Bitcoin up 15, gold up 27, and then German equities up 35% in local. Absolutely bizarro. And that is by design. They are pushing costs over to the Europeans, and that fiscal, what did Germany do? They took away their debt break after 08. Because of 08, when they went from 60% debt to GDP to 80, they put this thing called a debt break. It has a wonderful 27-letter German name, which I forget. And they just released it in March. So they're coming and spending. But along the lines of what Bill was talking about, it's not, Bill, I just said turnabout's fair play, where I was popping off like a whack-a-mole one in my tour of Europe, and you had to carry the day. So I said it's only fair that I had to go on while you rebooted.
I did reboot it, but I was also happy to see that you guys were just fine on YouTube. So,
all right, good. And since you're back, I'm gonna give it one more college try. The
Greenspan, by the way, is that the one you were?
Thank you. You know that thing of I've forgotten more than most people know. I just think I've forgotten things, so I don't know about the second part.
So I remember when people were criticizing him for having interest rates too low for too long, and that causing the global financial crisis. And then we had almost 2 decades of like low interest rates that were de minimis.
Which you're very familiar with, Bill. That whole era.
Yep. As they say, you wear the war wounds from those days. So I guess the point is policy is working. It may not be for everybody, but dollar's down 10.5%, oil's down, but rates are not down near enough. We can pick that up later, but rates are not even near. If rates don't get below 3.5 in the front end, they're not. They're 4.25, 4.5. Our interest rate expense will go up if we keep debt the same. And debt is not going to be the same. The ceiling will be raised in the next 3 to 4 months. And our 2.8% average coupon, 3.1, will roll up to this new regime, Christina, of 4.5. And we already know that 10 trillion rolled in the first 4 months of April at this higher rate. So where I'm going to end with is the Magnificent Seven. The Magnificent Seven, over the last 5 years, 6 of them averaged around 21% within spitting distance of each other. It was 27 to 35%, 18 to 35% on average over the past 5 years compounded, except for NVIDIA. And it's the same thing when you look at cross assets globally. Most of the assets globally, equities, gold, around 15% compounded annual growth rate 5 years, except Bitcoin, 63. So Bill, it looks like you and I did the right thing by getting into AI and Bitcoin, because they've led us into this and they're still persisting in the first 6 months of the year. NVIDIA had just a miraculous turnaround, down 35, up 35. Can't keep a good wang down, obviously.
And the stock market's back at all-time highs.
Bob's your uncle. Let's keep going. That's all I really had. especially without the charts. We'll share them later. Rates are going lower. Financials are higher, Bill, as you said. And whether it's 2 cuts or 1 cut, the Fed funds futures are the most variable, least reliable metric out there. They are not a predictor. They're very low information value. They are the Twinkie of financial sentiment. Looks good, doesn't really help you get over the finish line. All right, with that, let's bring on Christina. I want to hear more about your business, Christina.
Awesome. Thanks for having me.
Cool. So I guess we'll just start off at the beginning. Christina, can you just tell us about your journey, starting with you went to MIT, and then what you did with Domeyard, and we'll obviously get into Databento, and I think that'll be very instructive for our listeners. But yeah.
So maybe I'll frame it this way, right? Like when you first start a company, it doesn't matter what age you are or when you are, but I always think about when people always ask me how did you start a company? What made you decide to start a company? And I think back philosophically on or psychologically, I guess, on when did I start a company, why, and what made me do it. And I realized it was actually a combination of both things. That there were a couple things that went right, and then there were a lot of things that also went wrong. And I think it was a combination of both kind of factors that both pushed me into starting the company ultimately. So for example, the things that went wrong for me were things that are kind of relatable to a lot of people who are probably a little bit younger in their career right now, which is that I couldn't get a job, full time. It was competitive job market at the time, right? It was hard to get a job. Everything's really competitive, despite going to a fantastic school as well at the time. But still it was really hard to get a job and also get a job that I really wanted, I guess is probably the best way to put it. I could get a job, but just hard to get the kind of career that I wanted, etc. In the kind of field, maybe doing exactly what I wanted to do. I was really picky about what I wanted. So there's that. So I think factors like that definitely came into play. And so there's bad news pieces like that. Of course, I had an internship where I didn't get a full-time offer as well. So a combination of bad news, and then good news being having met the right people, right? So I had 2 co-founders who are fantastic, even to this day, who I wildly respect, and greatly admire today. And so again, having a combination of both good and bad at the same time were kind of the right, I guess, sparks, both that lit, the right kind of sparks that kind of fueled that fire, right? And so that was kind of what started and caused me to start that company. So I would say for people out there who are thinking about starting a company, you need to have both kinds of sparks. You need to have the negative and the positive at the same time, right? If you had too much positive, then why start a company when you're complacent in your life and happy? Then you don't need to, right? If you're happy in your job, you don't really need to start a company. I think it's when you're really mad about something, when you're unsatisfied with something, and there's a lot of bad things happening, then you want to start something, right? So it has to be a combination of bad and good. So anyway, that was kind of what brought me to start my first company, and then go from there. Yeah.
That's actually very helpful. I started my own company. It'll be a year in September or October, and I didn't really think about it so much, but the bad things that kind of happen and put you in that situation where you become a real risk taker. For people who succeed, it's I think.
Oh.
Yeah.
Bill,
it is. I'll finish it for Bill since we started about the same time.
But yeah, thank you for that context.
Oh, Bill's back.
So
yeah.
And Bill, you're coming in and out a bit here, my friend.
Yeah.
You're back with us.
I think your internet is a little bit shaky.
I restarted it, but yeah. I guess, can you just carry on from what that company was and what you ultimately did?
So that was a hedge fund. We focus on high frequency trading. People always don't believe me. Yes, we were co-located. Yes, we trade high frequency being we traded 25,000 trades a day. That is high frequency trading. We were trading a lot of trades a day.
So Christina, did you have to rent and actually go in and put it in there, or did you rely on one of the uh, providers saying you're as close as you can get?
Well, we would be as close as we could get, yeah. So, meaning, whether that was to, rely on a provider, for example, to be able to get there and, get into the data centers and stuff, yeah, we would do that as well. And
Wow.
thankfully at the time, yeah, I think a lot of the, there were providers that could, help us get there and be co-located there. So yeah, that's kind of what we did at the time, yeah.
And could you tell where you were in the lineup of closest to the node relative to
I
other
mean,
folks?
like, depending on the exchanges that we're trading in, right? Just highly dependent on the venues. So, like, for CME, we were just in DC3. We were in, I think, NY4 at the time as well, for like a lot of US equities venues as well. So just depending on which venues we needed to trade in, we were just like co-located within whichever data centers were appropriate for whichever venues. So, yeah.
Yeah. And has that changed a lot even since when you were doing it? Has it gone to like microwave and?
No, not as much. You'd
Okay.
expect it to be all in the cloud or whatever. I'm aware that, let's say, like CME is trying to do this like 10-year long migration into the cloud, for example. But again, that's going to take a decade long before that ever happens. Who knows? I understand cloud is the future of supposedly of this industry, but it'll be a while before I think everyone fully adopts, goes into cloud. So for right now, everyone is still kind of on-prem. It's still the norm in the market data space. Yeah.
And when you're at the hedge fund, which is the tip of the spear. I opened and closed my own hedge fund, later appreciating how hard it is to try to, run the business, maintain people, run your tech stack, investors, and then make money as things change. Why didn't you get back in, and what made you go to, the current venture you're in now?
Yeah, for sure. Definitely, like, I would say one is the hedge fund we ran isn't scalable. We wanted to actually build something that's scalable. And I know people always, it's funny, people actually, even to this day, message me and they're like, oh, they feel like going into the data business is like a whole step backwards in life, which I could totally acknowledge it is. But I'm a lot happier here personally. So I'm like, it doesn't really matter, like I'm a lot happier here. Surprisingly, I make just as much money, if not more, in the data business here. So again, it's like people don't expect that, but it is true. There's actually really good money in the data business. And why? It's because this business is extremely scalable. It is extremely scalable as a business. You can have a really fantastic exit in the data business, whereas in the hedge fund business, you can't. I can't sell my hedge fund. I mean, technically you can sell like the IP we built. Yeah, we can sell the IP, but you can't really sell the hedge fund like that. You just liquidate, redeem the hedge fund. Like you don't really sell the hedge fund itself, right? That doesn't really make sense. So, again, the hedge fund we built is not scalable, whereas the data business is. And so we wanted to build something ultimately that is scalable, but also too is like I want to really like challenge myself by building an actual product in this industry, right? Not just like I know trading is fun as well. I do still like kind of enjoy that and do miss that on occasion, but building a product, having recurring revenue is actually really fun as well. I think it's a different challenge as well. And what today is actually one of the best parts for me is like when I ran the hedge fund, I remember like all of our competitors, like all the other competing quant funds and stuff, whenever we went to events in the industry, they knew us, they wouldn't talk to us, they would avoid us, etc. Today, when we go to those same industry events, all of them would come up to us and be like, oh my gosh, Databento, we use you guys, we love you so much. The sentiment is the complete opposite of what it used to be because they are our clients now, right? And they treat us like equals. And the funny part is, even though, yes, we are a vendor, we should be licking their shoes, right? Like that's the sentiment that you would imagine it should be like. But it is totally like they treat us like we are not only peers, but a lot of them look up to us. They literally think of us like they're like, oh my gosh, these guys know what they're doing. They literally call us and be like, how should we do this? How should we, like build out our own data stack internally? Like many of them don't even know how to build it themselves internally. And, they're asking us how to do things because of our experiences of running the fund and building this data platform. And so anyway, yeah, so that's kind of, those are some of the reasons why. But again, like, look, to each their own, right? Like you can definitely run a fund today and still do an incredibly great job, right? And so I think for me, it's just personally wanting to build something slightly different in a different space and go from there. Yeah.
And when did you actually start Databento?
I started it over the pandemic. Just like I moved to Utah in like, what was it, early 2020? Oh, I like was going on a ski trip in March and then decided to kind of like just stay here. My parents like live nearby too, so decided to stay here in Utah and like decided to just move home instead. So yeah, I just that was like a big reason why I was like, you know what, like that was also the year that our hedge fund had the worst year of performance possible. And so we were like, okay, you know what, like since we had a bad year, we might as well just like, let's liquidate the fund, kind of redeem all the investors out and go from there. And I think that was the year actually that none of the investors have like voluntarily redeemed that year. So again, this is another lesson I always tell people is like there's a lesson between performance and like keeping your investors in the fund, right? Because the business of running a hedge fund is keeping your investors in the fund as long as you can. And the funny part was that actually, even though that year we were down, I think it was like 12% that year, our investors like they were like, oh, it's okay, keep going, you got this, and I was like, no, we're gonna actually like shut down the fund. And they're like, what? Like, it was like really funny because they wanted us to continue and we could have continued our business, but we were like, nah, no, we're gonna shut this down, get your money back. Like, we're not scalable, like we're gonna move on, right?
Christina, that's a great call. And you talked about knowing what you want to do from the beginning, because an industry may say, I want to give you money because I've already invested in you. And I don't care if you're losing your mind or if it's not the right decision for you. It's the right decision for me because, I think you're going to, you solve a purpose for my investor, needs and background. But knowing what is good for you and Bill even more so, has a lot of incomings from, say, college graduates and plus 5 years out about trying to get in the industry. And I think figuring out what you want to do is huge. And I love that you said that because, I mean, think if you hung around and, it might turn, but like, it sounds like you love a lot of aspects of this opportunity.
Yeah. The other thing is like I try to do what's in the best interest of the investors in the long run, right? And even though they might not see it now, I'm like, look, in the long run, like this is really not going to work out. And so let's do what's best for you guys now, and let's just cut our losses now, right, and move on. So yeah, I think it's the best thing to do.
Not easy. Not easy. Most people want to squeeze that last,
Oh yeah. Well, the other thing is like I get it. Like, look, people are, hedge fund managers we're all egotistical. We're all, we don't want to admit that it's our fault. It's the market's fault. It's you blame the markets and stuff. But I think a part of it, you just have to have the humility to realize, like, when things go wrong, right? I think I'm one of the most open founders, honestly, right? Like I am probably one of the only founders out there that actually openly talks about the hedge fund closure that we've done, and I've done postmortem podcasts where I just talk about the entire time, just the postmortem on why we shut it down, and just go through like detail by detail, like everything we did, right, and how we shut it down and stuff. I don't think anyone else does that. Like people usually just kind of shut it down and they kind of just hide and run away and pretend like it never happened, right? And I'm like, no, like I'm gonna tell you exactly why we shut it down and like here's what happened, and just be completely transparent about it. And the funny part is like, people still make fun of me and they're like, Christina's such a failure or whatever, and I'm like, like I voluntarily tell you this information, right? Like I tell you this, I live in a giant 5-bedroom house, multi-million-dollar home in Utah. Like I'm doing really well for myself. Like, I voluntarily tell you this information, and like, I don't have to share this. Like I just tell you this stuff because it's really fun for me to do so. So like, yeah, it's just funny to me that people still say that kind of stuff, but yeah. Anyway. But yeah,
Well,
that's basically the gist of what happened.
Perhaps the egotistical moniker applies to you. Having known you through conferences and getting to know you over a period of like 6 months now, I guess. I don't see a lot of the same like masters of the universe types of issues that some hedge fund founders and owners have, and the fact that you're willing to talk about it, I think, is unique. So 2020, you decide to start a data company. And I think maybe just we'll tell the audience, in case we didn't already, this is market data that you're providing to primarily buy-side clients. And why did you see that as an opportunity to start a new product?
I would say there's a couple things, right? One was just the experience we had at the hedge fund dealing with the traditional data vendors and the new data vendors too. We tried to work with all the startups, tried to work with all the incumbents, and just I guess this is the best way to put it is like, look, when you imagine yourself as a quant researcher, my colleagues, right, imagining themselves having a career as a quant researcher. And what they did not imagine was that they would be spending over half their time wrangling data. And I think that was a problem, really. That's the whole gist of the problem in a nutshell, right? Is like they're spending over half their time wrangling data in a way that's not what they want to do, right? Which is like they're like sourcing the data themselves. They're like cleaning up the data themselves, and the data should have arrived to them already cleaned up, but they're like, no, we got to like, figure out how to fix this and stuff. And then they have to like learn the microstructure of the industry themselves, because their data vendor doesn't know any better. And they have to figure out how to, almost like debug stuff and figure out if these data errors are the problem of the data vendor, or if it's like the market's going down, right? Like because the vendor just has no transparency over any of that. And it's a nightmare. There's no support, right? When you talk to support, like, they don't even know what's going on because you're just talking to a bunch of non-technical salespeople. There's like layers and layers of problems all over the place. The data quality is bad, the latency is bad, data goes down all the time. The sales process is bad, right? Like there's the pricing, depending on which salesperson you talk to, the price is different, stuff like that too. The licensing process is a nightmare. I could go on and on forever about this, right? There's just so many different problems. And then the use cases too, right? Like if you're starting, depending on your use case, the licensing can be different for the data. And we call it an innovation killer, depending on what your use case is. You're starting a company, and then, we even have, as a data vendor, we have to break it to startups and be like, hey, you think our data is expensive at, $200 a month. You imagine once you go to the exchange, right, and you have to pay for real-time data, they're going to charge you like $20,000 a month, right? No matter which data provider you choose, whether you choose us or another data provider out there, you're going to have to pay.
Okay, stop right there. I did do some homework on you, but how do you go from $20,000 to $200?
So it's actually what I'm talking about and referring to is actually the data licensing process, which is like for real-time data. There's like a rule in our industry where if you basically purchase real-time data for especially the major exchanges like NASDAQ or CME, for example, you have to pay them what's called basically monthly license fee. And that license fee will depend highly on whether you are an individual. It's usually it's cheaper significantly if you're an individual versus if you're like an institution, like a company or a startup even, you have to pay them significantly more than if you're an individual. And so yeah, like those fees can be quite a lot. If you try to skirt the rules, which we have seen a lot of even data vendors try to skirt the rules, which blows my mind, by the way, they will get fined. The startups themselves will get fined, the data users get fined themselves, and the data vendors will get fined and get in a lot of trouble for this too. So there's very strict rules around what you can and cannot do with the data and what the licensing looks like. So unfortunately, let's say if a startup works with us, they have to pay us for the data, but then if they get real-time data, they'll also have to pay the exchange every month like a license fee as well, separately from us. So yeah,
yep, I remember that on the Bloomberg days when you had to get the licensing fees.
Yeah.
So I think pain and suffering was really what led you to realize that this was a good idea, because solving that problem for buy-side clients was obviously very valuable to them. And I think that's, you're a very nice person, but I think part of the reason why they're so happy to see you at the conferences is because you solved a really painful problem. And I don't think that quants all approach all data vendors the same way, but if you actually solve a really difficult problem and a headache, of course it's appreciated, especially by people that get to start dedicating their day-to-day like operation to their highest and best use. You should be doing quantitative research rather than,
Yep.
spending time on the phone with vendors and essentially doing production support for things like data pipelines. And so Databento provides market data through APIs, application interfaces, and sort of helps solve part of that operational headache. But you also help them face off against all of the different providers, right? In terms of even just licensing. Can you just explain a little bit about your business model and how you have eased that pain as well?
Yeah, I mean, all we can do, right, is we're still at the mercy at the end of the day to the venues, the exchanges, right? And so if they charge a license fee, we have to abide by those rules. And so what we do, though, is we can still make it easier for the customer, meaning that we can help streamline the license process, whether that's some of the exchanges still allow us to just have like a form on our website where the customer just fill out a form and then just submit it and then they get the license if they're like an individual. If they're a company, then usually in most cases we have to introduce them to the exchange. We can try to move the process. We can debrief the customer on like, here's what the process will look like. The exchange will send you this form, or they'll invite you to get register on a website that you have to like fill out, depending on the exchange's process or whatever it is. And then also behind the scenes, just FYI, we also work with each exchange. If they ask us for feedback, we'll be like, hey, look, this other exchange does it better than you, right? Like, can you please adopt it this way instead? Because once we introduce it to you, there's no transparency. It just goes through a black hole. And then 99% of the time, we never hear back from the customer ever again. And they just leave us and they leave you. So you lose business and we lose business too, right? It's absolutely insane how that works. Like a customer comes to us so excited, right? They want to start a business, maybe they want to start a team or start a company or start a pod. I don't know. They want to start something. And then we introduce them to exchange, and then that is the end of the conversation. It's like they no longer start their company. They leave they leave the industry. I don't know, something happens, and
Wow.
it is like the end of the conversation after they get introduced to the exchange. I think it's because either just the conversation drags on too long, or they find out that the fee is ridiculously high. Something crazy happens in the meantime, and time just drags on. And anyway, so we just try our best to move people along that process as fast as we can, warn people about what that process will look like and stuff, and that way at least they're aware that this does exist. So that's all we can really do. Yeah.
Cool. And so the tech startup story, I guess, can you also just tell us a little bit about that? Like, did you do traditional fundraising? Like, how did you actually get the business off of the ground?
Yeah, so data is an interesting business, right? In that it's unique compared to like a B2B SaaS startup, even in that you need to have a certain amount of data, like a lot of data actually, in order to even start selling. Like you can't just have one piece of data and then expect that you can like sell to, I don't know, Citadel or whoever. Like you're not going to be able to even sell to like any customer, right? You need to have a significant amount of data. And there's a quote that I think we coined in it, like data scales nonlinearly, meaning that if you have one data set, if you have two data sets now versus one, two data sets will do more than twice as well as sell twice as well as if you have one. Four will sell more than twice as well as two data sets, right? And so on. And the reason why is because, like, for example, when we first launched, we had a lot of customers say, hey, come back to us once you have XYZ additional data sets. And we're like, oh, and then we started realizing that customers wanted to consolidate all their data, under one vendor, right? They don't want to have to work with like 20 different vendors with different data sets and 20 different APIs, right? That's not how they want to work. They want to operate as much as possible under a single, as much as possible under like a few vendors, like consolidate as much as they can. And so, yeah, that's kind of the nature of our space. And so you have to have a lot of data in order to be able to get to launch, which means that it's extremely like cost intensive at the very beginning. However, once you get to launch, then it's different compared to, let's say, if you're, I don't know, operating a regular brick and mortar retail business, like if I'm selling like, I don't know, shoes or something, right? Where I have to have like inventory and I have to like, I don't know, stack things up and like sell things physically. Whereas in the data space, it's different. It's like, okay, I can like sell data and like other data consumers don't know like how many other data buyers are behind the scenes. It's like, it almost feels like we have I can't say unlimited inventory because it's not technically unlimited, but it can definitely feel that way from the perspective of a user. So like it works differently behind the scenes, both pre-launch and post-launch in terms of how we scale. But anyway, so pre-launch though, because the cost is enormous, we do have to raise venture capital in order to get to launch. And then post-launch, what's interesting is that we can get to break even fairly quickly, I would say, compared to other types of businesses where like post-launch, they have to like hire more and more salespeople. They have to get more and more inventory, buy more and more supply. Whereas for us, it's like, okay, like, maybe we have to buy more, backfill more historical data on occasion. We have to, yes, we have to get more servers and more storage, right, on occasion. But at the end of the day, it's not like we have to hire like, 100 more salespeople or something like that, or buy like that much more data, because data scales like super well in this space. And, we can sell data to a lot of people and it's like, we'll still have those copies of data, right? So yeah, it's an interesting and nuance of our industry for sure.
So the operational leverage and sort of those upfront costs, I think, are actually very appealing. But to venture capital investors, tell us a little bit about how that went.
Yeah. So, for VCs, I think the most frustrating thing at the very beginning, right, for especially the earlier venture capitalists that especially came in, is that we're not a lean startup in the like traditional sense of what VCs might be used to, right? Which is that there's a book called Lean Startup in the Industry, which is actually written by the founder of Long-Term Stock Exchange, which is funny because like in the startup world, we know of this person as like the lean startup guy, right? And then in our world, in the data world, in the trading world, right, we know Long-Term Stock Exchange, and we would never assume that they're the same person. But anyway, lean startup methodology is basically like, in a nutshell, and I know I'm kind of butchering this a little bit, but basically the expectation in a nutshell is like, can you just build like an MVP, like, not overnight, but like, I don't know, over a month, over a weekend, as fast as you can, right? And just like launch it and just like start gathering customers, getting a little bit of revenue, right? Like get some pilots going and get something going, right? But the problem, okay, so like that sounds great if you're a B2B SaaS company even, right? Like, or you're B2C or whatever, right? You just launch an app overnight and just start selling. Mark, you're
on mute.
Thank you. You said you can't just build an MVP, or was that a
MVP, like a minimum viable product, right? Like a crappy app overnight. These days it's very easy. You can use ChatGPT to just, I don't know, build some app, right, and launch it on that iTunes store. I don't know, like, and just start gathering users right overnight. But in the data business, it's different, and the biggest reason why is because when we're selling to the smartest people in the world here, right? We're selling to quants, literally. And, these are like the smartest people basically in the world. When we are selling, like assume we're selling to like, I don't know, some of the biggest quant shops in the world today, right? These people are extremely smart. They can basically smell BS from a mile away. They can sniff out a bad product from a good product right away. And if they test out your product and it's bad, they will immediately walk away. They're going to mark your emails as spam from now on, and they're never going to look at you ever again, right? And so a product like us that's quality, which it is, we are one of the category defining products of of our space currently today, right? A product like ours takes years to build, to get to launch, and to do it correctly. That's why we get the compliments we do today. That's why if you Google us and you look at even Google us in random forums anonymously like Reddit, right? Where forums I don't even participate in anymore, right? People talk about us almost always actually in a very positive light. The only negatives you'll probably hear is like, we're expensive, and that's okay. We don't compete on price. Our benefit is actually that we just have a really good product, and that's exactly where we want to be in this industry. We want to be competing against the incumbents, not against other startups. I don't want to be a cheaper Bloomberg, right? Like, why would I ever want to start a cheaper Bloomberg? Like, That's not how the industry should be, right? We want to be better than, I want to be a better Bloomberg, not a cheaper Bloomberg, right? And by the way, we're not a Bloomberg at all. We sell to Bloomberg competitors, just to be very clear, by the way. We're one step upstream from Bloomberg. We provide the data APIs. We don't do the charts and the graphs and the analytics. We sell to a lot of companies that do charts and graphs and analytics and those kind of services. We sell to a ton of those types of companies downstream from us that are more closer to like a Bloomberg terminal competitor, but we don't have a terminal. So, but anyway, at the end of the day, again, that's kind of the us in a nutshell. Is that working with VCs at the beginning, I think the hard part is like if you're starting a company in our industry, right, selling to quants, the lesson learned is like expectation wise, you have to make sure to explain like, look, we're not a lean startup. It will take years to get to launch, and once you get to launch, as you can see, the payoff comes fairly rapidly, right? Within 2 years, like, if you tell our VCs, right, the pace at which we're gaining revenue today is, we actually just posted this too. Like we gained $1 million in ARR in the span of like 30 days or something. And it's only been 2 years since we launched, and we're already gaining $1 million in ARR in the span of 30 days. Like that's absolutely insane in terms of our growth rate for a company that launched 2 years ago. So that's kind of where we're at right now. And again, it was because we took our time to get to launch and to do launch a correct product during a time of high volatility in March. We were I think we were one of the few, I don't know if we were the only data vendor, but we were one of the few data vendors that did not go down. We were not down at all. Other providers were down. I heard some of them were down an entire day. For us, being even delayed by 15 seconds is unacceptable to us, right? Our standards are that high. But for other vendors, going down an entire day is what? It just blows my mind. So anyway, just that's kind of to give you a sense of the standards that we operate in. And
what's a distinction that you instituted to be able to, was it all volume driven? What went bad in March that folks were down for hours in a day?
It is, right? Because there's so much volume going on. There's a lot more data coming in periods of high volatility. It's everyone's starting to trade. There's a lot more volume coming in suddenly. The servers that we have, a lot of servers can't capture all that data all at once. And so everything just gets overloaded. And suddenly that's why everyone's data pipelines just go down all of a sudden. And just goes dark, and then people start to scramble, and they're like, "Oh crap, we can't handle this," because their infrastructure was not designed to handle this much data coming in. For us, Databento, we design our infrastructure 2 years in advance, literally. We design with the future in mind, and so we were prepared for this in advance. And again, institutional standards, right? This is how we build and operate. We actually talk to our users, by the way, when our users will copy paste their code, we will literally look and debug their code for them. That's how, we're a technical team of most of our team are just quants. That is how technical we are. Whereas other teams, they're built with salespeople, half of them are salespeople, right? Our ratio of salespeople, we have one salesperson in the whole company. That is the difference between us and other firms. And, and I think that's kind of the new, for us at least, that's our go-to-market, right? That's the new business model, is we noticed our audience, right? We just know our audience. Quants don't like to be sold to, right? I'm never going to call a famous quant in the industry, "Did you know you need data?" No one's ever going to drop everything and be like, "Oh yeah, I need data." That's never going to happen, right? So again, it's knowing your audience, knowing who you sell to, and talking to and treating them the way that you want to be treated in this industry. So yeah, so that's the other thing, is just knowing your audience as well.
and your employees, which we didn't even get into. Are there any qualities that are different that you've seen as to share with other folks about what makes a candidate stand out for you?
I would say for us, really meticulous attention to detail. We are extremely OCD as, for better or worse, right? As a product, people always say we're almost too perfectionist, and that could be a good or bad thing. But for us, our standards are extremely high. We hold ourselves to a higher standard than the incumbents absolutely, in this industry. And that's why we're good, right? That's why we have the retention, like almost 100% enterprise retention. That's why we have the high retention numbers that we do, is because we hold ourselves to extremely high standards. And so I think that's one of the most important things, is attention to detail. That means, like, when I look at a resume, right, I cannot see if I see a single typo on a resume, like, you're automatically disqualified. I don't care. You have ChatGPT at your disposal. You can literally plug your resume into ChatGPT and spit out a perfect resume for you, right? And if you can't even do that and you still have typos in your resume, like, I don't even know what to tell you, right? Like, you should really not have typos in your resume in the era of AI today. And so it just blows my mind that there's typos. People still make typos in this day and age, right? If you work in this job, you're gonna, software engineering roles, right? I assume you're gonna have typos in your code. Absolutely not acceptable. Like, just not acceptable in this day and age. Same with, like, typos in your writing, right? Your writing is going to go on our website, it's going to go on our blog, it's going to go on our marketing materials, in our collateral. Like, we can't accept that. Like, that's just not the standard that we operate with. And shockingly enough, I would say probably over 90% of candidates, resumes I look at, have typos in them. We have typos. They have
90%.
Oh yeah, typos and inconsistencies. And I have an eagle eye for it these days. Unfortunately, like,
People,
I love to
pay
review
attention.
resumes.
Christina's dropping a life-saving, career-advancing tip here. Use ChatGPT. Clean it.
Yeah, you can just plug it into ChatGPT, right? And just ask, like, ChatGPT, like, hey, or whatever is, like, Claude or whatever, one of those tools,
Claude,
right? And just
yeah.
be like, what
Yep.
what suggestions do you have, right? And, like, those are some of the details I would actually put in. Is just, like, suggest, listen to, like, the AI and, like, what AI would tell you to do, because AI is correct. Like, fix your typos and stuff, like, very basic things. Yeah.
Well, hopefully you've also encouraged your quants and engineers to do a good job with documentation, because that's
Yep.
one other area where sloppiness used to be the way, and there was almost like a creativity encouraged with some of this kind of stuff. And I think that needs to be replaced by meticulous attention to detail. And
Absolutely, yeah. Having great documentation standards, right? The way you organize your docs, the way everything, like the code snippets you have in your docs, everything has to be absolutely flawless in order to be acceptable. And so, yeah, absolutely. We spend a ton of time on our doc site, like, working on that. You'll see that our doc site is extremely extensive. We even map out our data architecture on our doc site. We have a page on our doc site talking about how we timestamp data. We talk about where our co-location sites are located. We have a page on our latencies. You can measure your own latency on our website as well. Like, stuff like that are just things that our users on occasion care about. They'll take a look and be curious about. So you can check out all those random things that most data providers' doc sites won't even have. Not just overall the basics of, like, how to implement our data, of course, but then there's all these other factors that we put in there too, just in case people are curious. Yeah.
We have a question from the chat. Diraj V asked, how would you compare your experience starting Databento versus Domeyard?
Hey, Diraj, it's good to see you. Yeah, so let's see, Databento. Okay, so I'm a second-time founder, right? So I would say that's probably the biggest difference. Is, as a second-time founder, I have a playbook of everything. I know almost everything. There's one thing I don't have a playbook of, and I'll tell you that later. So the playbook I have is, I know what lawyer to call. I know what accountant to use. I know all the software, like, I know which HR software to use to look at resumes. I know what bank to use to start, my, startup bank, whatever, right? Like, I know the kind of who to call up. I have a whole Rolodex of, like, everything in the startup world. So that saves, like, a ton of time having that playbook already in mind. And that's something so that way, like, I don't really need to do, like, a Y Combinator or some kind of accelerator anymore, because I already have that playbook. I'm like, okay, I already have that in mind. Like, I already know who's who. So that helps a ton. Of course, because my second startup is in the same industry as my first startup as well, like, that also helps too. Because it's like, okay, I already know my product better. I know my industry, like, extremely well. And so that also helps, because I have all the connections. I know the product very well in the industry and everything too. I was the consumer, I was the user beforehand, and then I've become the data provider now. So that's good. But I will say the thing that's harder the second time around is that the playbook I didn't have is sales, by the way, because my first company was a hedge fund. We didn't have to do sales. I mean, the only sales we did, the closest thing we did was investor relations, which was like talking to investors. It was more like fundraising. But sales was kind of illegal in a hedge fund, right? You can't really sell your hedge fund or whatever. Like, I'm not selling a product. I'm just selling investment strategies, and you're not allowed to sell, but you know what I mean, like sort of pitching and behind the scenes. And so because of that, like I never really learned how to sell a product, right? Whereas for now, it's like, okay, now I have to like suddenly cold email people, which scares me, and I still don't know how to do that very well, which is why we kind of don't do that. And then we kind of, have to, I don't know, like go to conferences and hand out swag and, do trade, like that kind of stuff, basically. That is new to me, and it is something that I am still not good at. It's something that I'm still learning behind the scenes and trying to improve upon still. So I think, yeah, that's probably still a harder part. But yeah, so second time versus first time, I would say second time is definitely a lot easier. But yeah, I don't know if that's what you're asking though, or were you more asking about like the day-to-day lifestyle? Because day-to-day lifestyle, I'll just quickly answer. Hedge fund, chasing alpha was fun. And also sexy industry, right? Like when we interview Canada, like everyone wants to work at a hedge fund. The bad part was front office dynamics versus back office, right? Everyone wants to work in the front office. That I hated that, meaning like everyone who worked in the back office was always like, we want to work in the front office one day. Whereas this data company here, it's like we never have employees who want to work in a different place. It's not like everyone wanted to migrate over to a certain place. It's like everyone is just happy on their team. Like there's no hierarchy, in the company where everyone wanted to go at a certain place. I love that. And so that's different. And then here at the data company, we can be remote, which also makes me happy. At least for now, we can be remote, which is good. And then what else? Yeah, I guess the hard part in the data company is definitely the sales aspect. That for me is tough still, like having to sell a product. So yeah, that's kind of the day-to-day in a nutshell.
Cool. Yeah, I think that did cover the question, which was really about starting up, which you covered very well. And so what's next for Databento? Is there like a new product that you're coming out with, or are you just going to continue growing sales in the same pipelines?
So we have, let's see, there's a couple things. One is like, of course, just, continue building out new data sets, like continue expanding like along our roadmap, right? And our roadmap, how do we determine that? We're at a stage which is interesting, which is that our customers are starting to pay us to be like, hey, if you die, we die too. And so they're like, okay, we'll pay you to like, go out to these venues and backfill this data for us, right? And that helps us to lower the risk. So that way, because traditionally when we go out to a new venue, we have to pay a certain amount of money to get the data initially. That is a risk to us because then it's like, what if we don't sell it? What if it doesn't pay off? If a customer says, hey, we'll pay you in advance so you can do this, that helps us enormously. And so we're starting to get customers that pre-sign with us, and they're like, hey, we'll pay you to do this for us in advance because we need this desperately too. That is so incredibly, like the fact that they trust us to be able to do this, right? And they rely on us, and they're like, hey, we want to do this with you guys, right? And we're willing to pay you in advance and wait for you to get this done with us. Like that means a lot to me. It's absolutely incredible that they're willing to do that. So that's kind of how we determine our roadmap. And then I want to also mention that there's
Hold a second. So your roadmap is determined by reverse inquiry.
We also have a public-facing roadmap as well, which is basically determined by customers as well. So I don't know if I'm allowed to share. I'll see if I can share my screen.
I'll be so jelly if you do that. No way.
Okay, it may not allow me to, but I will try my best. And
well, as you're doing that, I'll just comment on what Bill was talking about. This is crazy. You did it. All right. I'll send you my slides later to show up as well.
Okay. I think I'm sharing my roadmap actually. So
yes, you are.
We have a public-facing roadmap. I'm in incognito mode right here, and I'm not logged in, but you can literally see a Databento's roadmap. People will vote, as you can see. You can literally go on our website and upvote like items on our roadmap, and we will, basically put into production and develop things And you can come in and actually like people will come in and comment on stuff and be like, we need this, we need this, we need this, and that helps us decide, okay, people actually need this, right? Like we want to build something like this. And so that's how we, determine nowadays, like, what do we want to do? Let's listen to our customers, right? Like, let's not just like, I think that's the biggest way to get good feedback is like listening to our actual our power users, our customers, and get feedback from them. So yeah, that's really important to us too. I did want to mention really fast as well that we also play a metagame, meaning like we didn't just build a data vendor to just like play catch up with the incumbents. That we want to be at the forefront of the SEC overhaul of the industry, right? So meaning the competing consolidator rule that's coming out, and making sure that we're at the forefront of kind of any kind of new regulations that come out as well. So there's also that metagame, which I know is a whole story in and of itself, but just FYI that we do plan on kind of being on top of any kind of new regulations that come out as well.
Yeah, Bill, this sounds like what you were saying about highest and best purpose. This partnership that Christina's talking about, where people are coming in and saying, listen, my job is, my hair is on fire every morning. Not only did something break, but there's something new, a new demand or pull that I need to fix. I have zero time to do it. Can you get this done for me? And it's almost like that story about Nordstrom's where the person brought the tire back and returned a tire that they bought there, and the person behind the counter said, yes, we'll take that back. What'd you pay for it? Great, here you go. And the assistant said, well, we don't sell tires. It doesn't matter. We treat customers. And you'll just get that up and down where you have 8 ways to win in a hedge fund. If your number is not the right number at the end of the month, you lose. So that's something that I think when you're coming up in the space, you love the sexy hedge fund, but you're like, okay, well, there's a lot of give and not many ways to win. It can be a great business, but yeah.
I think it's also that, it's good when you win, but it's really, I remember the years when we usually lose money. It can also be really tough if you're not prepared, maybe mentally to handle, that stress and that pressure as well. So yeah, it can go both ways, but yeah.
And what would you say is the typical profile of one of your customers? Are they like high frequency quants, medium frequency quants, like all over the board, or how would you describe your
I
typical?
think we're at about 15,000 customers now, and it's everywhere. There's not a single profile that we can really define at this stage anymore. I can tell you like the bulk of our revenue does come from like medium and large financial institutions primarily. On occasion, there's also like various small institutions and also smaller pods and smaller teams that form as well within these institutions and startups too, on occasion. But yeah, it's tough to define like a single persona because we do have tons and tons of individuals that use us, tons of students that use us in school as well. The university typically will pay for the data. Sometimes the students will pay as well, depending on what kind of program they're in, what the purpose, if they're trying to build a startup, depends on the purpose and what program and what kind of purpose it is. So yeah. What else? There's people who use this for all kinds of like AI startups that will use us. We've signed recently with all kinds of companies in other industries that are unusual as well. So like biotech and healthcare, these are companies that would never touch a competitor, but they're using our data and we don't even know what they're using it for, completely outside of the norm of what you would ever expect in our space. And they're signing enterprise deals with us. They're getting real-time licenses with, NASDAQ or CME or something, and then they're signing like an enterprise license with us. And we're like, okay. And we're like, we have no idea what these like publicly traded healthcare firms, chances are it's something to do that they probably like manage their own books and they probably have a internal team that's doing some kind of like trading or something internally as well. But we really will never know. We'd never try to pry too much into that. But yeah, it's impressive like to see the types of companies that will sign on and come over. So yeah, and there's a lot of I guess in terms of hedge funds and stuff, there's high frequency. There's a lot of firms that will, surprisingly very latency sensitive firms that will come over to us. We offer co-location, by the way. So people are like, oh, do you have colo or cross connect? Yes. we have cross connects, we can do interconnects, we can do cloud on-prem, we can also just do regular internet as well for most people. And so that we can cater to any kind of customer. And then we have also, the non-latency sensitive folks as well. So yeah, we can kind of cater to a lot of folks. Yeah.
And how do you maintain capacity with like on-prem resources?
That's
Is
just
that a
like
scalable?
Yeah, constant build out. So our systems team is like 4 or 5 times bigger than our sales team to give you a
Wow.
sense. Yeah, so that's kind of where we invest our resources, right, into building the behind the scenes, the hardware, the systems, the networking, that kind of admin infrastructure. That's where that's really important to us to be able to invest in that and make sure that that's scalable. Yeah.
Cool. Well, hopefully we'll have another opportunity to bring you on and deep dive into some of the usage of Databento in the research process. But since we are running on an hour, we should probably wrap soon. Is there anything that you would like to tell our audience about, where to find you, where to find Databento, like anything at all?
Well, as you guys can tell, I always say I'm bad at sales, so I'm not going to try to sell the product. But you can find me. I'm typically I think I'm more reachable, usually actually on Twitter. I hate it when people again, I'm similar to my own persona that I sell to. I'm similar to the quants I sell to. I hate being sold to. I hate being solicited, which means do not email me. Do not DM me. I will not answer anyone. I will mark everyone as spam. Just like when I try to sell Databento to someone, they will mark me as spam too. So please don't do the same thing to me. I am the exact same as like the person I sell to. So I know my own persona, my own audience, because I am my audience. So yeah, like I would say the best way to actually reach me is surprisingly just like through forums like, Twitter. On occasion, I pop in. I've actually recently started popping into random Discords more often, just like anonymously usually. It's funny because like 1 or 2 people might recognize me because I don't know, they just know my username or something. But yeah, I'll pop into like anonymous trading, random trading algo trading Discord and stuff like that, which is really fun. But yeah, so yeah, I'll pop into those on occasion and just kind of say hi. But yeah, those are the best ways to find me. Usually LinkedIn, I'm very almost too active on. Sorry. So yeah, those are the best ways to kind of find me. But I would say please don't DM me. Just if you want advice, just try to comment on one of my posts or something. And then I like to just share with everyone, right? These things are useful for everyone. I don't talk one-on-one to people a bunch anymore. So yeah, thank you. That's probably the best way to reach me.
Cool. And I would also recommend that people don't steal memes from Databento as well.
So I'll just give you some context on this. So
Uh-oh.
our content on Databento is human made. A lot of our our content, right? We're one of those few companies finally remaining that doesn't use AI slop. We're not just using ChatGPT to generate AI crap to post on social media. We post a lot, but it's genuine human content. Our tutorials, our technical Python tutorials are handwritten, and they're pretty darn good, and so that's just something where when people copy us, which people do, they'll copy us and they'll pretend it's their own and they'll plagiarize us. And it really just, it's sad, right? Because it's we didn't use AI to build this. We actually genuinely spent a lot of time to do the stuff like that. And we've had a lot of instances. We had one instance where another company in our industry copied 98 pages of our website. 98 pages. That's insane. And they did it for SEO purposes. And we noticed it because they started to SEO. We look at the SEO tools. We're wait, their website's starting to SEO for the exact same terms. And then we noticed they copied us because they copied our typos. And their terms that they copied were terms that we coined. We coined those terms in the industry because we defined the microstructure of this industry. People don't even understand how much history we have in this space and how much of the microstructure we've actually defined in this space and stuff. But anyway, so yeah, long story short is we really do try our best to create genuine human made content. And
Christina, I just got a little window onto that hedge fund manager right there. You come for my stuff, I'm coming for you.
Yeah, I am very and that's one of the things that I'm very active on social media about is please don't, right? I'm not the type of person to take legal justice, right? I always believe that there's legal justice and there's social justice. Legal justice is expensive, right? Lawsuits take like 5 years to resolve. Hopefully not, but social justice is like, I will just post on social media and just shame someone. And that is like, it's just priceless. Like just shaming someone, ruining their reputation, like takes 2 seconds of my time. And it can just bring their company down instantly. And I've done that before. And that's what you get for copying 98 pages of our website. Like, and then having no remorse when I confront you about it,
Yeah.
and like not even, and denying it, and gaslighting me about it, and making me prove it to you, like, stuff like that. It really like, it feels like an episode of Silicon Valley, but it does happen in this space. And I still wake up and I'm like, I can't believe that happened. Like, it really feels like an episode of a TV show.
Totally. And
Yeah.
it's Bill and I find that, we'd like, hey, what about this guest, that guest? We meet him, like, well, how do we know them? Like, not everybody is a good actor in digital assets and in the data tech space, AI for sure. I mean, maybe that's
yeah.
not a surprise.
I'm shocked
So-
by that too, that, the number of bad, at one point in Databento too, we had quite a number of like scammers sign up for like actual scammers, meaning not people just farming data credits, which is one thing, which is like they start like 10 different accounts and, get like the free like data credits, which is like, that's a different thing. I feel like that's not as bad as scammers. Scammers, such as like they use a fake credit card, and then they'll fake someone's credit card or something, and then they'll download a lot of data, or they'll steal someone else's API key even, download a lot of data, and then they'll like leave. Like that is absolutely insane to me how common that is. So like that's the other thing, is like protect your API keys, right? Like don't post it on public GitHubs and forums. Shockingly enough, a lot of people fit with 15,000 users, like some people do, unfortunately, and it just doesn't. We have to catch it. We have to warn them. We have to reset their API keys all the time, because people will, like, scammers are out there, and they will like actually like use your credit card and stuff. So yeah.
Well, on that note, we should definitely all plan to protect our data and our online presence. I was plagiarized myself on Substack, which again, like I was very surprised too. But I think with the impersonal nature of online presence and quite frankly, the return on investment that you get for doing that kind of stuff, like I don't know. It seems like if Databento has memes that are good enough to go viral or whatever, people will see that as an opportunity, unfortunately. And I applaud you for taking them down.
I mean, the other thing is like, look, I know it sounds like I'm being insane and I sound crazy for rambling about this kind of stuff, but if I don't stand up for myself, who will, right? If I don't stand up for my company and defend the moat we've built and defend everything we've created, who will, right? And so it is my job in my job description to be able to stand up for my company, to be able to defend the things that we've built by hand, right? And to be able to take the path that's right in these cases, which is like not to sue everyone that copies us, because that's not the best. It's a waste of money and it's exhausting. But to just shame them on social media. And sometimes doing that alone is enough to get them to just take everything down and to walk away. And, and that's enough, right? And so again, just taking the right path forward, those are the kind of decisions that we have to just be able to make on a daily basis. So yeah.
Yeah.
Cool.
Good stuff,
Well,
Christina.
And I guess that is a wrap. So thank you very much. And hopefully we'll have you on again sometime in the near future.
Awesome. Yeah, thanks for having me. And likewise, Bill, it's really great to interview you a month ago as well. And it's really fun to be able to trade podcasts and stories as well. Just FYI for everyone here that I interviewed Bill a month ago as well, about his experience with the financial crisis, working at AIG. And so it was really funny that we have very, very different stories and in very different eras, and we traded stories. And so, I told Bill, I was like, please tell a story that you've never told before. And Bill was like, likewise, please talk about stuff you've never told before. So it was really, really fun to be able to trade stories amongst each other and share that with each other's audiences. So thank you so much.
Thank you.
Take care, Christina.
Yep. Bye, guys. Yeah.
All right. We are